All right, so with this piece, now I'm looking for my LIFO perpetual cost flow method. How am I going to do that? It's a perpetual method, so I have to record cost of goods sold at each data cell. So I'm going to stop on December 7th, right? And make sure that I only sell or allocate prices that were available at that time. So that means I can only go from either the December 5th purchase or the beginning inventory because I can't make a record on the 7th of December that includes prices I haven't even bought yet in reality. Right. This is just a hindsight bias because I'm giving you all the information for the period, but 12/7 LIFO perpetual cost of goods sold can only select from the beginning inventory or the 12/5 purchase, and we sold 20 units. And if I'm going with my most recent purchase, then I'm going to go with the ones that I just bought on December 5th because those were the last ones that I purchased. And if you go back to our work with the table, we know that this is 1206 per unit. So that's the price point of those 20 units. So I need 20 units. I got my COGS. I'm going to credit inventory. This is the perpetual COGS entry. 20 units times 1206 gives me $241.20. Okay, simple as that. That's all we have to record for COGS. Of course, there would be a sale entry too, accounts receivable and sales revenue, or cash and sales revenue, depending on whether we sold these on credit or for cash. But we're just concentrating on the inventory portion right now, so don't worry about that. But you do need to remember that under the perpetual method, every time we sell units, we record more cost of goods sold for the units we sold. So on the 25th of December, we sold 30 units. So I need a price point assigned to those 30 units. I'm going to go for these 20 first because they're my most recent purchase. According to my chart, those 20, right? No returns, so there are 20 in there. 20 at $10 per unit is going to be $200. So that's my first 20 units. Now I need 10 more. I want to go back until I can get more inventory. My most recent purchase after this December 20th purchase is the December 5th purchase. Now, how many are left here? Remember, I sold 20. I only had 23 after my returns. I sold 20, so there's only three left at that price. And remember, that price was 1206. So that is 36.18, $36.18 for those three units. And I only have 23. I need seven more, and I'm going to take those from beginning inventory. And that's $77 at 11 per. So I take the 200, the 36, and add the 77. That gives me $313.18. That's my cost of goods sold, my inventory. This is the absolute best way to really kind of show work here. That way I can tell how you might have messed up. Did you identify the right layer to pull from first? Did you remember the number of units you had in there? Did you think that there were still five units here because you forgot about the two they returned, right? So those smaller errors that you might make can give you partial credit for the rest of the stuff you got right. But if you just give me an amount, it's going to be really hard to figure out how you got this amount when you're talking about three different layers of inventory. So make sure you absolutely show me work, please. Finally, we have a third sell on December 30th. We sold 25 units, and I want to pull from my excuse me, my most recent sale or my most recent purchase because I'm using LIFO perpetual. So I'll take these. There were no returns. So I can get all 25 from this layer. This layer, they were 12.30 each. The price point was just the gross price plus freight. And that's $307.50. So that's my COGS inventory. All right. So I have these three entries would represent my cost of goods sold. Make sure you understand what a perpetual entry looks like, that it's dated at every date. We have to make a cost of goods sold entry every time we make a sell of inventory on that date. That's why there's three different ones because we had three different sales dates during this month. Make sure you understand that. Do not give me a periodic entry. It is impossible for me to give you partial if you totally mess up perpetual versus periodic. Okay. The next, before we talk about how to calculate ending inventory, notice we're under the perpetual method, right? So perpetual method with the inventory equation, that beginning inventory plus net purchases gives me GAFs. And GAFs really turns into ending inventory and cost of goods sold, right? So this is 100% true for my periodic. For perpetual, must include shrinkage. So for why this is okay for the periodic but not the perpetual. Because remember, under the periodic, anything that we don't find in our inventory count, we assume we sold. So under the periodic, cost of goods sold includes shrinkage. Under the perpetual, we can separately identify shrinkage. And so it's the same up to the point of gas, but then gas is going to equal ending inventory plus cost of goods sold plus shrinkage, right? So let's figure out my shrinkage first. We decided we had 9 units of shrinkage. We are going to assign the value of the units that were lost, stolen, they're just gone, right? We don't know what happened to them necessarily, but they're gone. Those 9 units should be assigned by the cost flow method with the units that are still remaining. So what does that mean? That means I'm using LIFO. I'm at the end of the period. My most recent purchases would be these here. Are they still there? Not all of them. I sold 25, so 5 are left. So I'm going to put those 5 at this price point, which is 12.30. And then I need 4 more. Well, where am I going to grab the 4 more from? LIFO still, so go back to the next most recent purchase, grab the 4 from that. And that layer had a per unit price of $13.30. So now I have both of my price per unit. That's going to be $61.50 for the 5. And then for those is going to be $53.20. So altogether, that gives me $114.70 of shrinkage. So how am I going to record shrinkage? First, remember, shrinkage is an adjusting entry. So that adjusting entry, most companies are going to embed it in cost of goods sold, just like periodic did. But you really have two options. You can just call it cost of goods sold in inventory. Some companies do that. If they do it, then they have to disclose it in footnotes, or it's a loss on shrinkage. and a credit to inventory. But either way, we need to reduce our inventory account by $114.70 for these lost, stolen, ruined, whatever, broken units of inventory that were in my shrinkage. Either way I do it, of course, cost of goods sold reduces net income. The loss on shrinkage reduces net income. Credit to inventory reduces assets either way. Well, now that I have my shrinkage broken out, I can absolutely determine my ending inventory because I know my goods available for sale way back here. Right? I said that would be useful. And now it's come to use $1,765.18. This is my goods available for sale. And that's going to equal my COGS plus my shrinkage plus my ending inventory. So my cost of goods sold is going to be all of my cost of goods sold entries, 241.20 plus 313.18 plus 307.50. So my total cost of goods sold is 861.88. Plus I have some shrinkage, $114.70 plus EI, right? So now I can solve directly for ending inventory without having to go back and count the units that were still left over after all of my sales were made. That can get a little bit taxing to do for me personally. So this is the way I like to solve it. That tells me that my ending inventory is $788.60 under LIFO perpetual, right? All these things under LIFO perpetual. Just solve this equation for my ending inventory. All right, the next video, we'll talk about the periodic piece.